Hello everyone and welcome back. Today we are going to discuss how to profit through stock market crashes like the one we had in 2020 automatically without having to learn to trade, hiring a fund manager, financial planner, or having to watch the market and pay attention and look at charts all day long. The industry and the government and all the banks, they want you to feel frustrated. They want you to feel confused and overwhelmed, so you continue to rely on them to help you. That's how they make their money. They want you to feel like you need them, but that's not the case. And by the end of this video, you'll find out why. So I'm going to show you the lies about the stock market that you probably believe, how to achieve your retirement financial goals faster. The average person in America, anyway, isn't reaching their financial goals at all. Our senior citizens have to work well into their 70s because they just don't have enough money. I'm also going to show you how to automate so you don't have to learn anything. There's no learning curve here. But in order to be able to understand that, you need to know the difference between the truth and what's fake news out there. So we will talk about that as well. So here's one thing that nobody has told you about the stock market. So imagine being one of these guys. Okay, so you're playing basketball at the playground. All of these players are playing in a recreational, have fun, relaxed, and relatively safe environment. That's why they feel comfortable even at their skill level, going outside and just having fun. But imagine if the only place where hoops and basketballs were available to you was if you were going to play against these guys. Some of history's best basketball players ever, in front of tens of thousands of fans watching, yelling, screaming at you as you're playing. We have Michael Jordan, LeBron James, Steph Curry, some of the best players ever. Imagine if your only option to ever play basketball was against these players in these stadiums in front of these people. That's pretty much exactly how the financial markets work. You're only ever allowed to compete with the best of the best, with Wall Street's finest. Not very fair, is it? So just think about if you were one of these guys playing against, Michael Jordan, the greatest player ever, and you're one of these guys, you're way too small, you're definitely not skilled enough, you don't have the conditioning, you just don't have any of the appropriate tools or the coaching or the trainers or any of the support necessary for you to be able to compete on this level. And that's probably how your experience has been in the stock market world as well. That is until now. Because now you can level the playing field and go toe-to-toe with Wall Street. I'm talking about using algorithmic intelligence to automatically time the market. Here's a sample of results from myself and my clients. Most of my clients have most of their money in the S&P. So this is the fairest comparison. The S&P 500, which is what most people use as the score to beat, the measuring stick of the health of the US economy and ultimately their investments, is a crummy little 3.36% as of the recording of this video. We've just barely started to recover from the COVID crash, as you can see here. This downturn is the COVID crash that we experienced in February, March, and just slowly grinding our way up. And finally turning a profit within the last month or so. Whereas with our AI, if you just look at the picture of this line, it doesn't look like there was any crash. How can that be when we're trading the same index, the same S&P 500? Well, you're about to find out why. So how did I figure all this out? As of 5 or 6 years ago, I did not think I would ever get into finance. I am not a guru whatsoever. I never thought I would get into this business. In fact, I come from a family of immigrants. And unlike most immigrants, though, my family came here already being millionaires from the wealth that they accumulated in South Korea. So this here is a picture of me when I was a kid. A lot of people think that, this is my mom, but it's actually my grandma. This is when they just came to America a few years after I was born. This is at the peak of their wealth. My grandparents owning their business in Queens, New York. My grandma was known as kind of the queen of Main Street when it was mostly a Koreatown back in the 80s. So I think this picture was around 1988 or 1989 when they were at the height of their affluence. But I say all this to actually make a point. If you fast forward to 2008, the global financial crisis just changed everything. I learned that my grandparents were going to retire with basically no savings. I thought once you became a millionaire, that it was easy to stay a millionaire, but that wasn't the case for my grandparents for some reason. 2008 was also the year I graduated college, and it was also the year that nobody was hiring entry-level college graduates. So this whole notion of go to a good school and get a good job, that entire formula, I lost faith in the entire system. And I kept asking myself, what was the point of becoming a millionaire if you can't maintain it? So I decided I really needed to get the personal finance aspect of my life handled. But it wasn't until I actually got hired at a hedge fund that I got to get a sneak peek behind the curtain and see how the billionaires operate. So this is what I learned. This is how billionaires invest. Billionaires don't lose money in stock market crashes. They also underperform the S&P 500 because average ROI does not matter. And we'll get into why it does not matter. I'm going to show you mathematical proof of why average ROI does not matter in just a few moments. They also time the market. Most people think this is impossible, but for billionaire hedge funds, equipped with the right knowledge and the right tools, it is not impossible at all. It's actually quite easy. They also keep a healthy portion of their funds in cash. They don't go all in all the time. So if you look at just these, this is just the tip of the iceberg of how billionaires invest, but this is just what's relevant for the scope of our conversation today. This is almost completely the opposite of how regular folks like you and me have been taught to invest. Most people go all in all the time and never sell, thinking that that timing the market is impossible. So they just put all of their money in a 401k, for example, and they just leave it. They'll lose money during crashes because they fully believe that one day it'll come back. This is highly, highly inefficient, and no billionaire that is worth his or her salt is ever going to invest this way. So here's the billion-dollar question. Would you sacrifice 25% of all of your profitable years if you could go back and reduce all of your losing years by 75%? If you can answer this question, then you've pretty much solved the puzzle of how to profit during stock market crashes. This is the billion-dollar question. In order to answer this question, I do need to switch over to Excel. And I know a lot of people think of Excel as a really scary mathematical technical tool, but I promise I'm going to make it super simple and walk you through it step by step. So what you're looking at here is the performance of the S&P 500 index, which we already discussed is the score to beat. It's what most people use as the measuring stick. And we have the beginning price of the year and the end price of the year since 1995 to 2020. I'm showing here in this yellow column the ROI, the percent increase or decrease depending on whether it was a winning year or a losing year. So this is 34% for 1995, 20% for 1996. If it's zero or negative, the ROI is listed in red. And as you can see, most of the time the S&P is gaining. But here's the question. Let's eliminate the data and just look at the ROI. If I take these 26 numbers over the past 26 years, average out those 26 numbers, I get the magical 9.5%. This is where your retirement planners or your financial advisors get their average return on investment figure from. 9.5% over the past 26 years. So it is absolutely factual to say the S&P will give you 9.5% per year on average. However, the way that information is conveyed is like this. They'll have you think if you start off with $100,000 of starting capital in 1995, that you'll have a steady 9.5% increase per year. That your estimate will just steadily increase all the way up until 2020, where you'll be sitting pretty with $1 million. This is what most people believe to be true. This is completely not the case. If we actually take $100,000 and apply the real, actual performance year by year, then we get something like this. You're sitting on 727,000, not a million. Your estimations were wrong by approximately 30%. You underperformed by over $300,000. This is why most people are not retiring with enough money. You're expecting your gains to look something like this, but you're actually getting this, and you're wondering what happened to all my money. And by the way, all of this is before you start paying fees. Because if you have a financial planner or a retirement planner or a fund manager, 401k, what have you, you are absolutely paying fees that you probably are not paying attention to because it's virtually invisible. Going back to the $1 billion question, what if you went back in time and you could sacrifice 25% of all of your gains, all of your green numbers, in order to reduce all of your red numbers by 75%. And let's take a look at what happens if we do that. So I'm adding another column here. If the number is green, we reduce it by 25%. If the number is red, we reduce it by 75%, so we lose less. So in other words, this is a good example. In the year 2000, instead of losing 10%, you only lose 2.5%. However, in years like 2009, instead of gaining 23%, you only gain 17%. At the end of the 26-year period, your average ROI would be 8.89% as opposed to the S&P's 9.5%. But look at if we apply this to starting capital of $100,000. What happens then? From 1995 all the way to 2020, you're actually sitting on $823,000 instead of what the S&P would have given you, which is $727,000. You actually made almost $100,000 more, even though you averaged almost a full percentage point less. This is what billionaires understand, and this is why they don't care about beating the S&P. They care about the number of dollars that they've put into their pocket at the end of every year. Losing is way stronger than winning. That's the takeaway from this chart. The reason this is a false belief is that it assumes no losses. It assumes steady 9% increase no matter what happens. This is not how the stock market works at all. This might be how a mortgage works or a loan works, but this is absolutely not how the stock market works. So you cannot use this formula and expect to get accurate numbers. But it is the formula that most of your financial advisors are using, which is why I call this a mistruth or a misconception. So what we have here is a chart of the 75-25 adjusted ROI, which is in orange, versus the S&P 500 straight up, buying and holding forever, in blue. So what you can see, we are underperforming the S&P for a while. That is until the global financial crisis crash. We don't dip nearly as much, and from then on, we just match the pace of the market, and we're always ahead of it. And so every crash there is, the separation will become greater and greater. It was underperforming until the first crash that we see on the chart here, which is the 2000 .com crash, or .bomb crash, I should say. That's when the score became more or less even. And you can see for about 5 years, we're just matching the S&P dollar for dollar. And in the next financial crisis, we see that the S&P drops. This is your 38% drop right here. But the AI does not drop nearly as much. And then from 2009 onward, it is just matching it. Now, it might be hard for you to tell here because we're still smack in the middle of 2020 as of the recording of this video. But the blue line did significantly dip down, and there is an increased bit of separation between the orange and the blue. So going forward, we can expect to see more of a separation as the orange continues to grow faster than the blue. Let's take this one step further. Instead of doing a 75-25 adjustment, we actually extend it to 85-15. In other words, I will sacrifice 15%, only 15% of my gains in order to reduce 85% of my losses. Then what we have is an average ROI that does outperform the S&P at 10.5%, and it even exceeds all of your false belief expectations as well. If we adjust the ROI to an 85 to 15, then we grossly outperform both in dollars and in terms of ROI percentages. This figure is more of a meaningless figure. I think you can see that by now. What really matters is the number of dollars in your pocket at the end of the day. Here, what you'll see is that we have outperformed the market significantly. The AI that we're using, that I'm talking about, is actually, this is very conservative even for the AI. The AI that I've been using for myself and my clients is actually closer to averaging like something, a same kind of formula here with the adjusted risk, but it does end up averaging out. If we actually apply this formula to it, it does end up being something closer to 12 or 13%. So what does all this mean about average ROI or average return on investment? It is actually a mistruth. A mistruth is factually correct information that leads to a false belief or misconception. So the 9.5% is completely mathematically accurate, but it leads you to believe something that's completely false because it assumes that you won't ever lose. That estimation makes a huge difference. As we saw, losing is much, much stronger than winning. So average ROI only works when you only have gains. For example, things like a loan or things like, car payments or a mortgage, things that where even if you miss a payment, it's not like the bank or the financial institution loses money. They just get money slower. You're just making payments. If anything, they're making even more money because the interest still compounds. They might be charging you late fees. So for them, it's green. When they give you this kind of language of average ROI, what they're actually giving you is applicable to green money language. This is something that I go through in my training course, The Secret Language of Billionaires, where you have to understand the difference between the green money language and red money language. Average ROI is only applicable in the green money language because it assumes only green returns. The stock market shows red or negative years regularly, as we saw. Even though it's mostly green, you do have crashes. In the past 20 years or so, we've had 3 crashes. And we've had more than 3 negative years of the S&P. So when it comes to the stock market that could potentially show red numbers, then you need to speak the red money language. The biggest problem in the industry right now is that your financial advisors and your so-called fiduciaries are giving you green money estimations for something that should be measured in red money language. Because most people don't know the difference between green money language and red money language, they assume that green money language estimations are always true, and then years later, when it's time to retire, they're surprised and they still don't quite understand what green money language is or what red money language is. There is a bonus here. There is a third money language as well, called blue money. This is not applicable for our conversation today because we're talking about investing for retirement. It is by far the biggest, most popular money language there is. So you can find out all about it when you sign up for my money language course.